Hi, I'm Tom Mihawk, and welcome to my personal finance course. This chapter is about taxes. This is the second segment. We just finished in segment one talking about having a high income and a low pre-tax income if you can, what April 15 in terms of paying taxes really means, deductions versus credits, all kinds of interesting stuff. Even knowing that taxes are hard to learn and they're really pretty boring, but it's so key to learn about taxes, and so that's why we're doing it. This is your year-end income summary. It's called your Form W-2. If you work for someone else, which most of us will, you get one of these at the end of the year. It usually comes at the end of January. It's meant to be filed in copy form with your tax returns, or if not, it's certainly what you use to calculate your taxes. Now, notice it has your name, your address, your wages, what you earn, Social Security wages, but key is your federal income tax withheld. And it describes how much you've had withheld. This is the number you use to true up your, when you calculate at April 15 what you owe in taxes for the year prior. It helps, you look to see what's been withheld and figure out if you need to pay more or if you're due to get money back. The impact of withholding on taxes is determined by what you've had withheld there. Sometimes if you don't earn much, but you have multiple jobs, you might have less withheld, and so you owe more. Or maybe you've had a big tax year, a big earning year, and you might over withhold and get money back. Or maybe take a new job and have to recalculate what your withholding should be. You do that, by the way, on your Form W-4. That's where you calculate and you determine how much withholding to do out of your paychecks. You have to learn to think in terms of before and after tax. And here's what I mean. Let's take, for example, these numbers. A pre-tax, so an after-tax, to have $72,500 after taxes in a 30% tax rate environment, or total 30% taxes, you have to make $103,571. I calculated that using my calculator. It's easy to do. What, by the way, might a $72,500 need be after tax? A tuition, a private school tuition like Villanova University, right? Private school tuition. You need to make $103,000. You just take 103, multiply by 0.7, which is 1 minus the tax rate, and you get 72,500. The cost or returns, assuming investments, for example, are far greater pre-tax than they are after tax. That's why you have to think in terms of pre and after tax. For spending, investing, purchases you make, deductible expenses. Let's take a $20,000 need. When you need $20,000 after tax, you have to make $28,571 pre-tax. Again, assuming a 30% total tax impact. What might $20,000 be for? Well, a car, for example, or maybe saving for a wedding, or toward a wedding, or saving for grad school expenses, or something like that. If you have an 8% pre-tax return and you're in a 30% total tax impact environment, your after-tax return is going to be 5.6%. Big hit, right? Big hit. So you read your statement from Fidelity, Vanguard, Goldman Sachs, Bessemer Trust, and it says 8%. But if it's taxable, it's going to be a much lower number after tax if it's taxed annually. Similarly, if you have a $1,000 pre-tax payment toward your mortgage, as an example, that's why I picked this number, and if you're in a 30% tax environment, after tax it's going to cost you $700. So the real cost of $1,000 per month, if it's all deductible, which means it's all interest in the payment at that stage, the longer you have your mortgage, the more principal is the more your mortgage balance is being paid down. But if it's all interest, in a 30% tax rate environment, it's really costing you $700. So you've got to start to think in terms of before and after taxes. If you want a $20,000 car, you've got to make $28,570 to be able to afford it. That's a big difference to start thinking about. Tax deferral is the ability to avoid taxation until some future time. Qualified and retirement plans do this. They permit avoiding taxation if they meet if they qualify or meet specific requirements. Some examples are 401k qualified plans sponsored by employers, IRAs or retirement plans contributed to by individuals. The traditional style, the money that you contribute is not taxed when you contribute it. There's no tax on any capital gains as the investment grows. It's taxed, however, at withdrawal, and there's a penalty required if you take money out before age 59 and a half, which means don't take money out before 59 and a half. You are required, however, to start taking withdrawals starting at age 72. So the government, the IRS says, look, we'll give you this benefit, but it's subject to certain rules. Your money can grow for years and years and years until you're 72 with no taxation, but it's subject to certain rules. Now, the Roth IRA or 401k allows you to contribute money that's already been taxed. So then there's still no tax on capital gains as the investment grows. Contributions and qualified distributions may be withdrawn, penalty and tax-free. So your contributions are definitely not taxed. Growth might be or might not be depending on whether they're qualified. You have to look it up. And this is where taxes get challenging because you have to look this stuff up and be aware of what qualifies and what doesn't. You're not required to make withdrawals at a certain age, which is great. The Roth, because you've already paid taxes, gives you more flexibility, more control yourself on when you take the money out. So always look for tax deferral when you have that opportunity. Here's the impact. Notice that for the male, he's being taxed every year. He's invested his money in a taxable account, a $100,000 initial investment with an 8% return over 20 years. The woman in this example is invested in a tax-deferred account. No taxation until she takes it out. So notice the difference. There's 52% more growth. The woman in this example has $160,000 more approximately than the man does because she deferred taxation. And you get this again through 401ks, IRAs, these kinds of things. When you can defer anyway, not avoid, in that case, defer taxation, do it. When you prepare your tax returns, initially, you might do this yourself, right? Research at the IRS website, call the IRS, there are workbooks and online aids. You might do this yourself several times. You may do this later, but I recommend here, do it when you're young, at least, so you understand how the flow works and how your taxes work and deductions and those kinds of things. You might early on, it's a first step away from just using a calculator, right? You might use QuickBooks, TurboTax, others. Increasingly, they're free online for simple returns. So, do the simple part. It's like a lot of things online these days. There's a freemium at the beginning, right? And you get it for free in the beginning. And if it becomes more complex, you have to pay for that assistance. The next step might be to use large national preparers like H&R Block and others that are moderately priced, but provide you with tax advice. Now, those aren't always the most sophisticated. Some might be, some advisors, some tax preparation people might be, but in general, they are seasonal and they hire people to provide tax advice for people who are, whose tax needs aren't always the most sophisticated. And then when yours becomes sophisticated, and I always tell students that my goal is to get you into more sophisticated tax planning, get you earning more income and having more deductions and using smart tax techniques to improve your financial planning situation over time. And when you get to that stage, use tax preparation services, CPAs and tax preparers, for example. I do that. I've done that for, a while now. Is it always worth it? Maybe not. There are times when I've come up with ideas that they didn't show me. But in general, they're far more aware of the tax situation. They're expert. I'm an instructor that in a topic that includes taxation, but I'm not a tax advisor. And they have software that helps you do what ifs, and those things can be beneficial. And by the way, that's probably available in QuickBooks and TurboTax too, and at H&R Block. Audits. About 1% of tax returns are audited. Some say that for earners between 25,000 and 200,000, less than 0.5% are audited. Some sample audit red flags, things you don't want to do to attract the attention of the Internal Revenue Service auditors. High incomes, you can't help that. When you have a high income, you're likely to be looked at because errors or omissions provide a better return for IRS auditors. High deductions relative to your income. Specific odd deductions, unusual, like for auto, travel, meal expenses, home office expenses. Businesses that show losses, especially when the loss is recurring every year, right? Why are you running the business if you're always losing money? Just to reduce your taxes? And unusual deductions, like local plumbers who deduct the cost of foreign travel for business purposes. It's not likely to be the case. You have audit rights, you have time to prepare, the right to get clarification. I have an Uncle Don. My Uncle Don's a bright guy, has 2 master's degrees. He once told me he was audited. He's been audited 3 times. I said, "Oh no, Uncle Don, that's horrible." He said, no. I got more money back every time. I went in with all my receipts, all my records. I laid them out and I found more tax benefit for myself than when I filed my returns. So he made it work out for himself. But no, you have audit rights, time to prepare, right to get clarification, and certain things that you file with your tax returns are more likely to attract attention than others. Avoidance and evasion. Tax avoidance is legal. You're permitted to use the tax laws to reduce your tax obligation. Pay your share, but there's no requirement to pay more. Decisions are most heavily affected relate to purchases, investments, retirement planning, taking of income, especially when tax rates are changing. Tax evasion, however, is illegal. You're required to report all your income, and you're required to pay tax to the proper jurisdictions at required rates. You must pay all the taxes owed and calculate them properly. For example, it's not illegal to have investments in a foreign financial services company that doesn't report to the IRS. A Swiss bank account holding your money is fine. What's illegal is not reporting a taxable event. So if you decide to have your money in a financial services firm that doesn't report, all right, fair enough. It attracts attention, by the way, but fair enough. But report taxable events. Report your taxes like anyone else. So tax avoidance is legal. Tax evasion is illegal. Learning about and researching taxes. Build good basic knowledge from this course, from watching this video, from studying, from listening to podcasts, reading blogs, talking to your friends. Be aware. Do all the things it takes, talking to people, reading, to learn more. There's a huge amount of information at irs.gov website. It can be dense. There's a lot there. Blogs, sites posted online by experts and writers. Phone the IRS on their hotline. Now, it's tough to get them during tax season, but I phoned the IRS with questions, and they're very helpful. They'll walk you through. You get experts in particular fields based on what your questions are, and sometimes it can be different, I've found, depending on who you get. There are IRS offices throughout the United States. I've also gone to IRS offices to do certain things. I forget, maybe I made a payment or I got help. I brought in documents and had questions. I forget. But there are many IRS offices throughout the country, and you'll find that you may need to use one at some point. Some tax reduction strategies. If you expect lower tax rates next year, accelerate deductions into this year, meaning if the tax rates are lower, 20%, then this year 30%, your deduction is going to save you $300 this year on a $1,000 pre-tax event versus $200 on a pre-tax event next year. Delay the receipt of income into next year when the tax rates are lower. If you expect a higher tax rate next year, delay your deductions into next year for the reciprocal of what I just described in the first example, and accelerate receipt of income into this year so it has a lower rate. Increase your contributions to tax-deferred retirement plans. Look for tax-exempt investments and look for tax credits for use of solar power or better windows with better, energy-saving windows or those kinds of things. You can look those things up. In my classes, we always look for these kinds of tax reduction strategies. Again, these are legal. The IRS has a philosophical view that if you use energy-saving windows, solar panels, own a home and deduct your home mortgage payments. You know, those things are good for society. So that's why the IRS does that. And those kinds of strategies are things that you want to be aware of. So this has been the second segment of the two-segment tax chapter. Thanks for watching. I'm Tom Mihawk. Here's where you can find me. Thanks for watching, and please come back for my next chapter.